Every trader wants a reliable map of the financial markets. For decades, classic Elliott Wave Theory has been marketed as the ultimate map. But what happens when a map itself keeps changing while you are actively risking your hard-earned capital? Today, we are stripping away the academic hype and exposing the real-world limitations of classic Elliott Wave and why blindly counting patterns might be putting your trading account at serious risk. Let's start with the absolute foundation of the theory. Ralph Nelson Elliott claimed that the market is a perfect mathematical fractal. He argued that every major impulse wave always divides into 5 clear subwaves, and those subwaves divide into 5 more microwaves. If you look at a textbook chart, it looks incredibly clean. You see a perfect upward leg 1, a small pull back for leg 2, a massive surge for leg 3, a sideways consolidation for leg 4, and a final push for leg 5. It looks flawless on paper. But let us talk about the reality of live trading. In the live markets, this perfect 5-wave structure is a complete myth. Price action is driven by dynamic liquidity pools, high-frequency algorithmic executions, and massive institutional order flows, not textbook geometry. Real trends do not care about a fixed numerical count. If you look at a live chart of an index or a volatile stock, you will see that the market routinely moves in aggressive 3-wave bursts that act as powerful impulses. Other times, it stretches out into messy, unquantifiable price action that defies any 5-wave division. When you force your eyes to see 5 waves in every single trend, you're simply hallucinating patterns that do not exist. You are forcing the market into a rigid box where it does not belong. Believing that the market must mathematically split into 5 subwaves is the very first trap that leads to a forced bias, rigid trading, and ultimately, massive stop-loss failures. If a trading framework is truly objective and scientific, 2 professional traders looking at the exact same data should reach the exact same conclusion. If you look at a simple moving average or a horizontal support level, everyone sees the same line. But what happens when you apply Elliott Wave? Look at the example on the screen. This perfectly illustrates the problem of subjectivity. We have the exact same price action shown side by side, yet look at how the labels are forced onto the candles. In reality, an impulse wave does not always have to follow a strict, rigid 1, 2, 3, 4, 5 count. In the real market, a powerful, high-velocity institutional impulse can move cleanly as a 3-wave ABC structure. But because classic textbook theory brainwashes traders into thinking every impulse must be 5 waves, look at how they force their bias onto the screen. On the left side, the analyst forces a 5-wave impulse count, breaking a natural 3-wave move into an imaginary subwave structure. They label a minor swing as wave 1, a small dip as wave 2, a sudden push as wave 3, a drift as wave 4, and the final high as wave 5, drawing a straight trend line beneath it to justify their rigid count. Now, look at the right side of the screen. It is the exact same asset, but the numbers are shifted completely. The placement of wave 1, 2, 3, 4, and 5 is altered because another trader saw a different microscopic wave extension to satisfy the exact same 5-wave rule. This is the ultimate subjectivity trap. Instead of simply identifying the true impulse and corrective behavior of the market, wave practitioners waste time fracturing a clean ABC impulse into imaginary subwaves just to force a textbook count. Who is right? No one actually knows until after the market has already moved and the account is blown. Because the theory is incredibly fluid, it turns into an art form disguised as a science. You stop reading what the institutional orders are actually doing, and you start trading your own forced, subjective illusions. This brings us to the biggest structural flaw within the Elliott Wave community, something every trader notices sooner or later: the endless relabeling excuse. Have you ever noticed that an Elliott Wave analysis is always 100% accurate on historical data? If you look at a completed chart from last year, the waves look beautiful, perfectly numbered, and perfectly placed. The reason for this retroactive perfection is simple. When a live market breaks a rule and invalidates a count, the analyst does not admit their setup failed. They just change the labels. Let's look at a live chart scenario. You label an upward move as Wave 1 and a downward move as Wave 2. You place your buy order at the bottom of your supposed Wave 2, expecting a big move. Suddenly, a massive institutional sell order hits the market, and the price crashes straight down, breaking below the absolute starting point of your Wave 1. According to the strict rules of the theory, Wave 2 can never retrace more than 100% of Wave 1. Your count is officially invalidated. But instead of accepting a stop loss and admitting the trade analysis was wrong, a classic wave trader will simply open their charting software, delete the numbers, and rewrite history. They will say, "Oh, that was not an impulse wave turning into a reversal. It is actually a highly complex WXY correction or a truncated fifth wave." This is an incredibly dangerous way to manage risk. Shifting letters and numbers around post-facto is just an excuse to hide a bad analysis. The theory gives you so many structural escape hatches that it never forces you to face market reality in real time. If your system requires you to constantly change the labels to remain correct, your system is fundamentally broken. Module 4, the time-symmetry myth and the symmetry decision rule. Let us expose a major missing link in classic Elliott Wave analysis that almost nobody talks about: the complete breakdown of time symmetry. In true physics, natural patterns, and algorithmic market delivery, time and price are deeply interconnected. Velocity is your ultimate indicator. If you look at the example on the screen, we can break down the absolute reality of the symmetry decision rule. True market symmetry dictates that corrective phases of the same degree, such as Wave 2 and Wave 4, must share an equal proportion in time and structure. A true corrective wave, whether it is labeled as a Wave 2 or a complex link Wave X, is inherently a complex, messy, and range-bound phase. By definition, a counter-trend correction is designed to build liquidity and trap retail capital. Therefore, it must consume significantly more time than the explosive impulse wave that came before it. The main trend should be exceptionally fast, while the counter-trend must be slow and dragged out. But look at how incorrectly classic Elliott Wave is applied in the real world. Many amateur wave practitioners will look at sharp, violent, high-velocity move down and instantly label it as a Wave 2 or a link Wave X. This is fundamentally inaccurate. A sharp, fast vertical crash is not a correction. It is an impulse. If a downward move is over in just a few quick candles, it lacks the necessary time duration to be classified as a major corrective phase of that degree. If your supposed Wave 2 or Wave X takes less time to form than Wave 1, your structural map is entirely wrong. True corrective behavior cannot be rushed. Look at how a real Wave 2 or a complex WXYZ combination correction operates when it respects the symmetry decision rule. It grinds sideways, creates overlapping candles, and consumes days or weeks of data to completely mature, often matching the exact time footprint of the later wave for consolidation. When a theory completely ignores the relationship between price velocity and time duration, analysts end up labeling fast, aggressive counter-trend impulses as simple corrections. By forcing numbers onto a chart without measuring time symmetry, classic Elliott Wave fails to capture the true mechanics of how institutional orders are distributed across time blocks. Module 5. Identifying impulse versus corrective behavior. So what is the actual truth behind charts? Let us strip away the confusing letters, the endless subwave numbers, and the academic fluff. The absolute core of successful market analysis comes down to one single, powerful realization. You need to stop obsessing over labeling every micro-movement perfectly, because micro-labeling breeds execution failure. The market does not trade based on numbers or letters. It trades based on structural order flow. Instead of getting lost trying to decide if a move is a complex wave extension or a specific subwave, your entire focus must shift to a much simpler, more powerful question. Is the current price action an impulse-strong move in the direction of the dominant trend, or is it a corrective counter-trend phase? Let's break down what this looks like in reality. When you look at an actual trending market, You're looking at an alternating cycle of expansion and rest. An impulse behavior is characterized by large, expansive candles, rapid price velocity, clean displacements, and sustained directional momentum. This is a strong move where institutional big money is aggressively pushing the market, clearing out liquidity, and driving prices rapidly toward a specific target. It can appear on your screen as a powerful, continuous upward run or a heavy, one-sided liquidation drive. On the flip side, look at a corrective countertrend phase. A correction is characterized by small, highly overlapping candles, low volume, frequent wicks, and a complete lack of directional velocity. A correction is a resting phase. It is a slow, messy, sideways grind designed strictly to build liquidity, trap retail traders, and prepare the market for the next big expansion. It moves against the main trend, but it moves with absolutely no real strength or urgency. When you shift your focus to reading this raw behavior, your trading completely transforms. You realize that a major upward trend is essentially one massive macro impulse made up of localized impulsive thrusts and shallow corrective resting periods. You stop guessing whether you are in a minor degree subwave 3 or a primary degree wave 5. You stop forcing arbitrary labels onto candles that do not fit textbook patterns. Instead, you train your eyes to simply read the velocity and structure of the market. If the move is fast, clean, and aggressive, you track the impulse. If the move is slow, choppy, and overlapping, you recognize the countertrend correction and wait for it to exhaust itself. By prioritizing behavioral order flow over rigid textbook labels, you stop trying to predict exactly where the market must turn, and you start tracking exactly where the big smart money is already flowing. Module 6, Bridging the Map, Integrating Liquidity with Elliott Wave. Now that you understand the difference between raw institutional impulse and slow countertrend corrective behavior, it is time to look at the missing key that bridges the macro map with real-world execution. That key is liquidity. Classic Elliott Wave Theory treats the market like a closed mathematical system, tracking wave counts as if the market must reverse purely because a certain wave degree has met a textbook structure. But in modern electronic markets, prices do not reverse because of a number or a letter on your screen. The market moves for one single reason: to seek out and consume liquidity. Major institutions, high-frequency algorithms, and market makers do not care about a standard 5-wave count. They care about where large pools of stop losses and resting orders are sitting. This is exactly why combining the macro perspective of Elliott Wave with institutional liquidity concepts is the ultimate game changer for modern traders. Instead of trying to buy blindly at the absolute bottom of an assumed wave 2 or wave 4 retrace, you must look for where the retail market has built up clean engineering liquidity. Look at your charts for equal highs, equal lows, and obvious trend lines where retail stop losses are heavily stacked. When you spot a macro wave structure completing, you do not just jump in. You wait patiently for the market to aggressively sweep those liquidity pools first. Once the market sweeps the retail stops and taps into an institutional order block, it validates that the smart money is active. This integration of market structure and order flow liquidity completely removes the dangerous guesswork of classic wave trading. It transforms Elliott Wave from a subjective guessing game into an objective, highly weaponized roadmap. This exact integration is the core framework taught inside our specialized training program, Elliott Wave plus SMC Mastery on Udemy. We engineered this specific strategy to show you how to map the higher time frame cycles with wave mechanics, but timing your actual execution based on raw liquidity hunts and institutional footprint entries. Understanding this relationship means you stop being the liquidity for the big players, and you start trading directly alongside them. We're going to discuss liquidity. If you do not understand liquidity, you are simply providing it to someone else. To trade like a professional, you must completely unlearn the retail concepts of support and resistance. Institutional algorithms do not care about a line you drew on your chart. They do not bounce off magical barriers. Institutions require massive amounts of volume to enter and exit their trades without causing slippage. To get that volume, They have to hunt for areas where thousands of retail orders are resting. That resting fuel is called liquidity, and in trading, liquidity simply equals stop losses. Let us start with the most common retail trap, equal lows. When retail traders look at a chart and see the price bounce off the exact same bottom level 2 or 3 times, they see a strong support wall. They buy the asset, and they place their stop loss directly below that wall. When you look at that exact same double bottom, you must see something entirely different. You must see a massive, glowing pool of sell stop orders. The institutions know those stops are there. The algorithm will intentionally drive the price down, crash through that strong support to trigger all those stop losses, absorb that liquidity to fill their massive buy orders, and then instantly reverse the market to the upside. This is why you constantly get stopped out right before the market goes in your anticipated direction. You are used as liquidity. To navigate this, you must understand the difference between internal and external liquidity. External liquidity rests at the absolute extremes of a major market structure. It is the stop losses resting above the absolute highest peak of a macro impulse wave or below the absolute lowest valley. Internal liquidity, on the other hand, is built up inside the choppy, messy subwaves of correction. The market moves in a continuous cycle of sweeping internal liquidity to fuel a run toward external liquidity. It grabs the internal stops of the impatient traders in the middle of the range, builds institutional momentum, and then violently breaks out to sweep the external stops at the edges of the macro structure. This brings us to the ultimate liquidity trap in our advanced wave system, the expanding flat. To the untrained eye, an expanding flat looks like absolute chaos. It looks like the market has lost its mind. But when you view it through the lens of liquidity engineering, it is a masterpiece of institutional manipulation. Think about the structure of an expanding flat. Wave A sets an initial range. Then, wave B pushes up and breaks the high of wave A. What happens here? Retail breakout traders see the high broken, so they blindly buy the breakout. At the same time, early short sellers get their stop losses hit. The institutions just swept the external liquidity at the top, trapping the buyers. Now that they have engineered short liquidity, they aggressively reverse the price into wave C. Wave C crashes all the way down, slicing straight through the absolute bottom of wave A. Now the trap flips. Retail traders see a massive breakdown of support. They panic sell and short the market. Meanwhile, all the buyers' stop losses are triggered. The institutions have now swept the external liquidity on both sides of the market. They have trapped the breakout buyers at the top, and they have trapped the breakdown sellers at the bottom. Once that final wave C sweep is complete, the market has maximum fuel, and it violently explodes in the direction of the macro trend. When you combine your wave knowledge with liquidity, you stop getting chopped up in expanding flats, and you start waiting for the final sweep. Now, let's apply this to a highly specific, incredibly profitable buy setup using a regular flat. Imagine the macro trend is strongly bullish. We have just completed a large impulse wave up, and the market begins to correct. It drops to form wave A, creating an initial low. It bounces up to form a choppy wave B. Finally, it rolls over and begins wave C, dropping back down toward the wave below. This is the exact moment you must pay attention. As wave C drops, it just barely breaks below the low of wave A. Put yourself in the mind of a retail trader looking at this chart. They see a clear downtrend. They see the previous support of wave A being broken by red candles. Their textbooks tell them this is a bearish breakdown. They aggressively place sell orders, and anyone who bought the wave A bounce gets stopped out. But as an advanced wave and SMC trader, you're looking at the exact same chart and smiling. You know the macro trend is bullish. You know this is just a corrective structure. When wave C breaks the low of wave A, you know exactly what just happened. Wave C has just completed its structural requirement, and it has simultaneously swept the internal liquidity resting below wave A. This is your sniper entry. You are not selling the breakdown. You're actively looking for buy opportunities. You zoom into a lower time frame, look for an institutional order block right at that sweep level, and you enter a buy position precisely when the retail world is panicking. You are buying the exact moment the institutions have finished accumulating their fuel. So, once you enter this trade, how do you set your targets? We do not use arbitrary percentages or random risk-to-reward ratios. We target the opposing liquidity. Because you bought the sweep at the bottom of a corrective flat, your primary target is the external liquidity resting at the absolute top of the macro structure. You're targeting the equal highs or the macro peak where all the early short sellers have placed their stop losses. The market swept the bottom to find a fuel, and now we use that fuel to hunt the top. This is the power of combining structure with liquidity. You know the direction, you know the trap, and you know the target. Study your charts. Train your eyes to see the liquidity pools. Don't get me wrong. Elliott Wave is a wonderful, monumental piece of financial study. Ralph Nelson Elliott's original observations of market fractals and human psychology were decades ahead of his time. He correctly identified that markets move in repeating cycles driven by mass human emotion. But like any century-old tool, it has distinct structural limitations that modern retail traders must completely address, fix, and remove if they want to survive and scale in today's highly competitive, automated markets. We do not need to throw the baby out with the bathwater. We do not need to completely abandon the concept of market waves. Instead, we need to evolve it for the algorithmic age. And that is exactly why our course, Elliott Wave plus SMC Mastery, is currently one of the newest and hottest trending programs on Udemy. This course is designed to completely strip away the confusing, highly subjective subwave fluff that causes analysis paralysis. We completely remove the guesswork and replace it with rule-based precision. We show you exactly how to pair a clean macro wave map with highly objective, precise execution tools from Smart Money Concepts. You will learn the exact mechanics of using institutional order blocks, liquidity sweeps, fair value gaps, and lower time frame changes of character to find precise, high-probability entries with incredibly tight risk management. Traders all around the world are already leveling up their execution using this exact framework. In fact, our growing global trading community already features over 40 active students spanning across 13 different countries worldwide, including major hubs like India, the United States of America, Malaysia, Turkey, the United Arab Emirates, Spain, the United Kingdom, Hong Kong, Montenegro, Nigeria, Serbia, Singapore, and Thailand. Stop losing money chasing a perfectly labeled textbook count that doesn't exist in reality. Learn how to map the macro trend cleanly and learn how to execute with institutional precision. If you want to join us, make sure you use the special promotional link in the description below. By using my direct link, you will unlock a special, exclusive discount applied automatically to your enrollment. Click the discount link in the description below to enroll in the Elliott Wave plus SMC Mastery course on Udemy today. Secure your special pricing and let us evolve your trading edge together.